Perhaps this budget should have been penned in red ink. The deficit is forecast to hit $57.6 billion, $22 billion more than estimated in February. But that's only part of the story. The financial year that ends in June must go down as the largest turnaround in budget history. An expected $21 billion surplus has hemorrhaged into a $32 billion deficit. And there are deficits as far as the eye can see. A grand total from now until June 2013 of $219 billion. The largest chunk of that is down to a revenue loss of over 5 years of $210 billion, but there's also been $97 billion of new spending committed, and that's calculated over 4 years. It all adds up to the federal government's debt peaking at $188 billion in 2013. As a share of the whole economy, that's 13.8%, lower than the high watermarks of the 1990s, and the government's keen to point out, much lower than many other advanced economies. But it's coming from below zero, and government borrowings will rise to $300 billion. Treasury is forecasting no growth this year and a recession in the budget year of 2009-10, with the economy to contract by 0.5%. And there will be below-trend growth in the following year. After that, Treasury expects the economy to rebound and grow strongly. The slowdown will leave more than 1 million people on the jobless queues by the middle of 2011. But Treasury argues that without stimulus spending, another 200,000 would have been out of work. It also says that spending will add 2.75% to gross domestic product in 2009-10.
But this is a budget about nation building, and it's a budget about nation building for recovery. It's about the big projects that create the jobs of the future and create the wealth of the future. It's a budget that's focused on the short term, the medium term and the long term.
The budget winners are single pensioners who'll get an extra $32.49 a week. Couples will get an extra $10.14. It comes, though, at a huge cost to the budget bottom line, $2.7 billion in the first year and $14 billion over 4. The government says it will meet the cost of all its new spending in this budget through reform. So the qualifying age for the pension will be progressively increased from 65 to 67 at the rate of 6 months every 2 years. But that doesn't begin until 2017, and the pension will taper out more swiftly as private incomes rise. The cap on concessional superannuation contributions will be cut from $50,000 to $25,000, and the cap for over 50s from $100,000 to $50,000. But in 3 years, that will fall again to $25,000. For low-wage earners, the co-contribution rate will be reduced from 150% to 100%. The government will save $1.4 billion by hitting the pause button on indexing the upper income thresholds for family tax benefits A, B and the baby bonus for 3 years. Private health insurance rebate will be trimmed. Singles earning over $120,000 a year and families on more than $240,000 will lose it. And the surcharge for not taking out private insurance starts rising once you earn more than $90,000 until it reaches a 1.5% tax slug for the uninsured earning more than $120,000. The budget flags $22 billion in infrastructure spending over the next 4 years on roads, rail, ports, universities and hospitals. But some of that money has already been flagged. It includes an extra $3.5 billion for a clean energy initiative, investing in carbon capture and storage and large-scale solar technology. Another $2.6 billion will be spent on universities and $3.2 billion on health infrastructure. But the traffic isn't all one way in health. The government wants to claw back more than $800 million through measures like capping Medicare safety net benefits. The first homeowners boost will continue as it is until the end of September and then halve to $10,500 for existing houses and $14,000 for new homes. All up, the budget predicts savings of $22 billion over 4 years.
The hard choices we have taken won't jeopardise recovery, but they will put the budget back onto a sustainable path. And they aren't just ordinary savings. They are long-term structural reforms that help put the budget on a sustainable path despite the substantial demographic challenges that we confront.
That's a start, but many will argue it won't go near achieving the task of returning the budget to surplus by 2015-16. Someday, a future Treasurer might have to do a lot more heavy lifting.
Welcome to this special edition of the 7:30 report, coming to you from Parliament House, where the Treasurer has unveiled a budget framed in response to the worst global economic slump since the Second World War. Wayne Swan will be with us shortly, but in the interim we're going to do some quick analysis to test the claims and assumptions on which Wayne Swan has based his budget bottom line. For instance, how credible is it when we're told that the world economy is in uncharted waters to predict boom growth of 4.5% for the Australian economy just 3 years from now, for 2 years in a row, in fact, when next year the economy will actually contract by 0.5%. Where is the real horror in what we've been told for months now would be a horror budget? Or is it a Clayton's horror for the vast bulk of Australians? How responsible is it to increase the single-age pension by 10% or $30 a week and the combined couples pension by a more modest $10 a week at a total cost of $14 billion over 4 years, when the nation is heading for a $57 billion deficit next financial year? I'm joined first by budget specialist and former Treasury official Chris Richardson of Access Economics, the ABC's business specialist and the publisher of Business Spectator Alan Kohler, and our own political editor Michael Brissenden. Chris Richardson, first, you've been able to absorb some of the budget. What's your immediate response?
I think some of those growth assumptions are optimistic. Yes, we had great growth out of past recessions. Two things will hold it back this time into the recovery. One is that families will be wanting to save more than they've been doing for a while. That will slow the recovery. And so too will the fact that in a few years from now, the boomers will be retiring in big numbers. That slows down the economy side, maybe more than they've allowed. And the policy side is a disappointment. We've been promised a tough budget, and this is not it. All promise, no delivery. OK,
in terms of the deficit, do you accept the claims of this budget that they will be balancing the budget by 2014-15 and in surplus by 15-16?
Not off the back of the nasties we've been told. We are simply promised that a combination of good growth and the promise from the government to keep spending growth to 2% a year after inflation will do it. Now, that doesn't tell you anything. It doesn't tell Mr and Mrs Smith what benefits they lose. It doesn't tell which sectors will lose their industry welfare. It's hiding the big and bad adjustment task which still needs to be done. And my fear is we'll keep hiding it all the way through to the next election, and neither side will fess up to the tough choices needed.
Alan Kohler?
Well, I agree that it's actually a bit of a non-event, this budget. It's a necessary non-event in many ways because there's really nothing much they could do. They had this massive deficit, which was already locked in a way, by the economic downturn and the decisions that had already been made. So there really wasn't much they could do. What they did do was $6 billion worth of expenditure initiatives in this budget for the next financial year. And I tend to look at these things 1 year at a time because there's a budget every year and a whole lot of new decisions in the next budget which wipe out the last decisions. And half of that is the pension increase, which is really unfunded. This stuff about it being funded by an increase in the pension age on the never is really nowheresville, really. And so I think that there was really nothing much they could do in the budget, and it's kind of a non-event.
And those growth figures?
Well, actually, the thing to look at is nominal GDP. The numbers you mentioned of 4.5% is real GDP, but in order to get the impact on government revenues and expenditures, nominals, that's real plus the inflation numbers. The turnaround in the nominal GDP is even more dramatic, from minus 1.5% in the next financial year to 6.75% in 3 years' time. A colossal turnaround that they're forecasting, which I don't think is credible at all.
Michael Brissenden, the politics.
Well, I think we're all agreed that it doesn't match the rhetoric of tough that we'd heard in the last couple of weeks. In fact, most of the pain, such as it is shovelled on in the last 2 years of the 4-year forward estimates, which is well after the next election. So in many ways, like most budgets, it's framed politically to get the government through to the next election. And I think the 4.5% growth figures are important. It does underpin the message that the government wants to sell, that they can get this budget back into surplus by 2015. But there is a lot of room here for the opposition. $300 billion of debt, of borrowing. That gives the opposition an opportunity in the next little while. But again, I think the growth figures are, the optimistic 4.5% growth figures are the things that are going to underpin the government's argument about returning to surplus, and that's important.
OK, Michael Brissenden, Alan Kohler and Chris Richardson, thanks. And to